Have you ever wondered why some high-income earners seem to keep more of their money while everyone else feels crushed by taxes? It's easy to assume that wealthy people are using secret loopholes or special privileges that ordinary Americans don't have access to. But the truth is often much simpler. Many high-income earners legally reduce their tax bills by understanding the tax code better than the average person. They know that the U.S. tax system isn't designed only to collect taxes. It's also designed to encourage certain financial behaviors like investing, saving for retirement, starting businesses, and creating jobs. The result is that two people earning the exact same income can end up paying dramatically different amounts in taxes. Today, we're going to explore how high-income earners legally reduce their tax bills and why understanding these strategies could completely change the way you think about money. One of the biggest tools high-income earners use is tax-advantaged retirement accounts. Most people know about a 401k, but many don't maximize its potential. Contributions to a traditional 401k are generally made before taxes, reducing taxable income for the year. Imagine someone earning $250,000 annually who contributes the maximum amount allowed. That contribution can lower their taxable income significantly while simultaneously building long-term wealth. Many high earners also take advantage of backdoor Roth IRA strategies when their income exceeds the normal eligibility limits. While these approaches require careful planning, they demonstrate how understanding the rules can create substantial tax benefits over time. Another major strategy involves investing rather than relying entirely on earned income. The tax code often treats investment income differently than salary income. Long-term capital gains, which apply to investments held for more than a year, frequently receive more favorable tax treatment than ordinary income. This means someone earning money through appreciating assets may face a different tax situation than someone earning the same amount solely through a paycheck. High-income earners often focus on building portfolios that generate growth while minimizing unnecessary taxable events. They understand that it's not just about how much money you make, it's about how efficiently you keep it. Real estate is another area where wealthy individuals frequently reduce their tax burden. Rental properties can provide cash flow, appreciation potential, and valuable tax advantages. One of the most powerful concepts in real estate taxation is depreciation. Even if a property increases in market value, owners may still be able to claim depreciation deductions that reduce taxable income. In some situations, investors can also use strategies like 1031 exchanges to defer taxes when selling one investment property and purchasing another. These legal provisions were intentionally built into the tax code to encourage investment and economic growth. Business ownership creates another layer of opportunities. Many high-income earners operate businesses, consulting firms, or side ventures. Business owners may deduct legitimate expenses necessary for running their operations. Office equipment, software subscriptions, professional services, business travel, and certain home office expenses can potentially reduce taxable income when used appropriately. The key point is that these deductions are not loopholes. They are legal provisions established by the IRS. Business owners simply understand how to document and claim them correctly. High-income earners also focus heavily on tax planning throughout the year, instead of waiting until tax season arrives. Many people think about taxes only when filing returns, but successful individuals often meet with accountants and financial advisors months in advance. They analyze income projections, investment gains, charitable contributions, and business expenses before year-end. This proactive approach allows them to make strategic decisions, while there is still time to influence the outcome. By the time April arrives, much of their tax planning has already been completed. Charitable giving is another strategy frequently used by wealthy Americans. Donations to qualified organizations can provide meaningful deductions while supporting causes they care about. Some individuals contribute appreciated stocks instead of cash, allowing them to avoid certain capital gains taxes while still receiving charitable benefits. This creates a win-win situation where both the donor and the charitable organization benefit. Again, this is not about avoiding taxes through questionable methods. It's about using incentives that lawmakers intentionally created to encourage philanthropy. Perhaps the most important lesson is that high-income earners don't necessarily pay less because they have secret knowledge. They often pay less because they spend time learning the rules and working with professionals who understand them. The tax code rewards certain behaviors, including investing, entrepreneurship, retirement savings, and charitable giving. Those who align their financial decisions with these incentives frequently discover legal ways to reduce their tax burden while building long-term wealth. At the end of the day, reducing your tax bill legally isn't about finding shortcuts or exploiting hidden loopholes. It's about understanding how money moves through the financial system and making informed decisions that take advantage of existing tax laws. Whether it's maximizing a 401k, investing in assets, owning a business, utilizing real estate opportunities, or planning ahead with professional guidance, the principles remain the same. The people who keep more of their income are often the people who understand the rules best. The good news is that these strategies aren't reserved for millionaires. Anyone willing to learn, plan ahead, and think strategically can begin applying many of the same concepts. Because in the world of personal finance, it's not just what you earn that matters, it's what you keep.